Structuring. Structuring happens when large amounts of cash are broken into many smaller deposits that appear ordinary on the surface. The practice became more common after financial reporting rules were introduced in the late 20th century, requiring banks to flag unusually large transactions. Instead of placing one obvious deposit, the money is divided and spread across different days, locations, or accounts. Sometimes multiple people are involved, each handling a portion of the funds, and the deposits may be made at different bank branches to avoid patterns. Over time, the activity blends into routine banking behavior that looks no different from normal personal banking. It matters because the total value of the money remains hidden, allowing illegal profits to enter the financial system gradually while staying below reporting thresholds. Shell companies. Shell companies are businesses that exist mostly on paper, with little or no real operations. They can be registered quickly in many jurisdictions and may have official addresses, directors, and bank accounts, yet produce no actual goods or services. These entities became more common as company registration moved online and international business became easier to manage across borders. A shell company can hold assets, sign contracts, or move money while shielding the identity of the true owner behind layers of paperwork. Sometimes, several shell companies are linked together in a chain, each owning the next. It matters because investigators often need to untangle multiple legal structures before identifying the person who ultimately controls the funds. Trade-based money laundering. Trade-based money laundering uses international trade to move value across borders while disguising the true nature of the transaction. Goods may be deliberately overpriced, underpriced, or misrepresented on shipping documents to justify moving extra money between countries. For instance, a shipment of low-cost electronics might be declared as premium equipment, allowing additional funds to be transferred under the appearance of payment. This method expanded alongside the growth of container shipping and complex global supply chains, where millions of shipments move daily. Inspectors can only examine a small percentage of cargo, which leaves room for manipulation. It matters because trade documentation is complicated, and small discrepancies can remain hidden within a vast volume of legitimate commerce. Cash-intensive businesses. Cash-intensive businesses are operations that naturally handle large amounts of physical money, such as restaurants, convenience stores, taxi services, or entertainment venues. Because daily cash sales are difficult to verify with precision, extra funds can be quietly added to the reported income without obvious signs. The owner may record higher sales than actually occurred, balancing the books to match the extra cash being introduced. This method has existed for decades and was especially common before electronic payment systems became widespread. Even today, certain industries still rely heavily on cash transactions. It matters because the business appears legitimate to customers and regulators, and the financial records can be adjusted to make illegal funds look like normal earnings. Real estate laundering. Real estate laundering involves buying property with illicit funds and later selling, renting, or refinancing it to create the appearance of legitimate income. Property markets have long been attractive for this purpose because transactions often involve large sums and assets tend to hold value over time. A building or apartment can also generate rental payments, which provide a steady explanation for incoming funds. In many cases, the property is purchased through a company rather than an individual, adding another layer of distance between the money and its owner. In major cities around the world, authorities have noticed patterns of expensive homes being purchased and left empty for long periods. It matters because real estate connects financial activity to physical assets that seem stable, respectable, and difficult to question. Casino laundering. Casino laundering takes advantage of gambling venues where money is routinely exchanged for chips and then converted back into cash or electronic transfers. A person may buy chips, spend only a short time at the tables, and later cash out, receiving documentation that shows gambling activity. Even minimal gambling can create the impression that the funds came from legitimate winnings. This method became widely discussed in regions with large casino industries and heavy tourist traffic. Casinos are designed to process high-value transactions quickly, which allows large sums of money to pass through the system with little delay. It matters because the official records generated by casinos can make the origin of the money appear lawful. Money mules. Money mules are individuals who move funds on behalf of someone else, often through bank transfers, withdrawals, or digital payment services. They may be recruited through job advertisements, social media messages, or personal relationships, sometimes believing they are participating in legitimate work such as financial processing. In other situations, they knowingly assist in moving money for a commission or small payment. The role itself is simple, but the network behind it can involve many participants spread across different countries. Each person handles only a small portion of the funds, which reduces suspicion. It matters because spreading transactions among multiple people makes the financial trail harder to follow and delays investigations. Offshore accounts. Offshore accounts are bank accounts held in foreign countries, sometimes in jurisdictions known for strong financial privacy protections. These accounts are commonly used for international business, investment diversification, or managing assets in multiple currencies. However, they can also be misused to store money outside the reach of local authorities or tax agencies. The expansion of global banking and online financial services made it possible to open accounts remotely without visiting the country in person. Funds can be transferred across borders within minutes, often passing through several financial institutions along the way. It matters because differences in national laws and regulations can slow down cooperation between governments and create gaps in oversight. Front companies. Front companies are businesses that appear legitimate and may even provide real products or services, but their primary purpose is to support hidden financial activity. Unlike shell companies, they usually have employees, customers, and visible daily operations. The company might run a normal storefront or office while quietly channeling funds through its accounts behind the scenes. In some historical cases, organized groups used small retail businesses as fronts because they attracted little attention and handled regular cash flow. The presence of genuine sales helps disguise unusual financial patterns. It matters because the mixture of real and concealed transactions creates records that seem authentic and trustworthy. Loan-back schemes. Loan-back schemes involve sending money through an intermediary and then returning it to the original owner as a formal loan. On paper, the funds appear to come from a legitimate lender, complete with contracts, repayment schedules, and interest payments. The borrower can then explain the money as financing rather than unexplained income. This method has been used in both corporate and personal financial arrangements, especially where large investments or property purchases are involved. The paperwork surrounding the loan can look detailed and convincing. It matters because loans are a routine and accepted part of modern finance, so the movement of funds may not immediately raise suspicion. Hawala. Hawala is an informal money transfer system that relies on trust between brokers rather than traditional banking channels. It has existed for centuries, long before modern financial institutions developed, and remains widely used in many regions for sending remittances quickly and cheaply. A person gives money to a local broker, who contacts another broker in a different location to deliver the equivalent amount to the recipient. Instead of physically moving cash across borders, brokers settle their balances later through trade, cash exchanges, or other financial arrangements. The system depends heavily on personal reputation and long-standing relationships. It matters because its speed and privacy make it useful for legitimate purposes, yet its informal structure can make financial monitoring more challenging. Art and collectibles laundering. Art and collectibles laundering uses valuable items such as paintings, sculptures, rare coins, or antiques to store and transfer wealth. Prices in these markets can vary widely depending on reputation, rarity, and buyer demand, which creates flexibility in assigning value to an item. Transactions are sometimes conducted privately between collectors, with limited public records about the final sale price. A piece of art can be purchased, held for a period of time, and later sold at a different valuation, creating the appearance of investment profit. Wealthy individuals have long treated art as both a financial asset and a symbol of prestige. It matters because the lack of standardized pricing allows large sums of money to change hands without clear financial benchmarks. Cryptocurrency mixing. Cryptocurrency mixing involves combining digital coins from many sources and redistributing them in new forms, making the original transaction path more difficult to follow. This method appeared after cryptocurrencies became widely used, and blockchain transactions could be traced publicly by anyone with internet access. Mixing services attempt to break the visible connection between sender and receiver by pooling funds together and sending them out in smaller, unrelated amounts. Some services operate automatically through software, while others rely on coordinated networks of wallets. As digital assets continue to grow in popularity, new privacy tools are constantly being developed. It matters because the speed, anonymity, and global reach of digital currencies challenge traditional financial monitoring systems and require new approaches to regulation.